This is the 2017 ratios question. Again, it's before we'd start, just take a note of what you're being asked to do, okay? So do ratios, then see what you're being asked to do. So advise the bank manager if a loan on which 6% interest will be charged, which should be granted. Now, that changes the way we're going to write. We're still going to write from a debenture holder's perspective, but it's a few extra little things that we have to put in, and we'll see that as we go. As always, just check the net profit and the interest, and so the interest is above the net profit as normal. So just be aware of that. And the last thing is the preference shares. 5% of 150 is 7,500. So we'll probably use that number. And we'll definitely use that number and highlight your 135 as your share price. Okay. So part A, our first 50 marks is our 5 ratios. You'll see a lot of them begin to repeat themselves. So we've seen certainly 4 of these probably actually in the past. So the first one is the closing stock if the rate of stock turnover is 10 based on average stock. So that's our 2 part 1. So we've our answer to our rate of stock turnover is 10. So the rate of stock turnover is cost of sales over average stocks. That equals 10. So if we just slot in what we know, cost of sales, and the question is 565. 565, that should have been over average stock equals 10. I've worked that out then. 10 times average stock, just cross multiplying, is 565 it should have been. So average stock is 56,500. Openings, and then average stock we know is opening stock plus closing stock over 2. So 73,000, which is our opening stock given in the question, plus our closing stock is going to be 56,000 divided by 2. Or 56,000 multiplied by 2, sorry, which is 112,000. So 112 minus 73 is not 40. It's, I don't know what it is, but it's certainly not 40. So it's 39,000, I suppose. So, sorry, I just made a mistake in that, but I'm sure everybody got that. Just follow that process. It's a 2-step one. Okay, second one is the dividend yield. So we know dividend yield is dividends per share over the market value of 1 share. So we have to work out the dividend per share. So dividend per share is ordinary dividend over issued ordinary shares. And ordinary dividend is our dividend paid, 50,000, minus our preference dividend of 7.5. So 50,000 minus 7.5 over 450, and you're multiplying that by 100 over 1 to get it into cent. So it's 9.44 cent. So now then we go, our dividend yield will be 9.44 cent of the share price, so 135 cent. So 9.44 over 135, multiplying our answer by 1, because we know that it's it's a percentage, so that's 7%. Okay, next one, earnings per share. Now, more often than not, we're asked the price earnings ratio, but we're asked the earnings per share, which is very straightforward. So earnings per share is just net profit minus preference dividend over issued ordinary shares. So net profit of 114, preference dividend of 7.5, issued ordinary shares is 450. Again, multiplying our answer by 100 over 100 to turn it into cent. 23.67 cent, or 0.2367 euros. Okay, that was it. Then we're asked return on equity funds. Now normally we're asked return on capital employed. So return on equity funds is a different formula. So it's net profit minus preference dividend over equity funds. And equity funds is ordinary share capital plus profit and loss balance. So our net profit is 114 minus the 7.5, and we're going to divide that by 450 plus 79. That's 20.13%, obviously multiplying by 100 over 1. And our last one then, interest cover, net profit plus interest over interest. So 114 plus 16 over 16 equals 8.13 times. So that's not a percentage, it's a times. So we don't multiply that one by 100 over 1. Okay, So that gets us onto our report. Now I've gone through them very quickly, so I'll post the answer as well as the video. So the reporter asked to advise the bank manager if they should give the loan. So within this, it's, as I said, it's similar to the debentures, but a few extras have to go in. So you have to refer to the loan at different points, particularly around the interest cover and the gearing, things like that, and the security on the fixed assets. You need to say, well, this is what the current position is, and this is what the position will be if the loan is granted. Okay, now I've obviously done the question and I came back and said they should give the loan. Okay, because pretty much everything's going to be positive. Now we're still following the same process. It doesn't ask us to do it under state of affairs, performance, state of affairs and prospects. But you can follow that same process, and we're going to put everything in following that same process. Now you can leave out most of the shareholder stuff, so you can leave out return on equity funds, and you can leave out most of the dividend stuff, bar the dividend cover, when you're not asked from a shareholder perspective. I normally would put them all in anyway, but I was in a bit of a rush, so I just know that within the marketing scheme you're definitely not going to be asked that. So anyway, profitability, you're looking at your return on capital employed, and hopefully it's a positive trend. So it's a profitable company with a net profit of 114,000. Return on capital employed, now normally you've worked that out in part A. I had to work it out, so it was 14.79, which was an increase from 12% the previous year, which is a positive trend. Now, as always, compared to the risk-free rate, it's well above the risk-free rate of return of 1 to 2%. Now, then we have to compare it to the debenture rate and the loan rate. So it's also well above the cost of borrowing, which is the debenture rate of 8%, and it's above the loan rate of 6%. So we need to mention both of those. And that shows that we're making efficient use of our resources. Okay, so that's what we have to mention on profitability. We're going to compare it to our debenture rate as well as our future loan rate, and that gets everything boxed off to get us full marks. So that's the only slight difference. Now that is not in your notes. I might update the notes, put these little things in if you're asked on borrowing, although I might have them. Dividends. Dividend policy. The only thing that the bank manager is going to be concerned about is dividend cover. So we're saying that the dividend cover, and I worked it out to be 2.51 times. Obviously, you'll have to go and work that out. Last year was 2.25 times, so that's an increase. So they're retaining more of their profit now, and retaining profit is good when loans are in play because they're putting money aside to pay back the loans or for any future expansion. And I think you should refer to the fact that they can pay back the loan, so they'll have no problem paying back the loan or that payout policy. So if that increases, there's less of a likelihood or less problem with them paying back the loan. They're not paying out too much of their dividends. Okay, I could write about dividends per share and work that out. I know from looking at the marketing scheme, we didn't need that. And generally, you only really need to talk about dividend cover for debenture holders and bank managers. I would suggest you do it all just to be on the safe side, especially as you're not going to be caught for time this year. Liquidity is our big one. Well, liquidity, the next three, I suppose, liquidity, gearing, and security and the fixed assets. So the state of affairs ratios, they're the important ones. So the asset test ratio, 1.11, you might have to check that because I used my incorrect figure for closing stock, but it's in and around that. So the asset test ratio is 1.11, which is an increase from 0.81, which is a positive trend, and it's above the ideal of 1:1. So you're going to be happy enough with that. So they don't have a liquidity problem. So as usual, stick in your line about having €1.11 of liquid assets for every €1 of short-term debt, and they'll have no difficulty paying short-term debts as they fall due. Now, really, because we're talking about loans, the short-term element of a loan is the interest. So you need to refer that they won't have any problem paying their interest with that liquidity position. So they're not going to have any issue paying the interest on the loan, which is 18,000 per year, as long as their liquidity remains above 1:1. Okay, so that's how we're going to get it in. And I would mention that the interest on the loan is going to be 18,000 per year. Okay, so gearing and interest cover. Now this is where we're going to do the gearing twice. And we're going to explain it out twice. Interest cover, you could do it a second time if you want. The only thing is you don't know what the profitability is going to be post the loan, so you don't have to get too into it. But you do have to show what the gearing is before the loan and after the loan. So what I wrote is that they've got a gearing of 39.82%, which I worked out, and that's down from 45%, which of course is a positive trend with gearing. So they're low geared, and now they're even lower geared. So I wanted to put that in, that they had low gearing, and now they've even more lower gearing. So the company is much less financed from debt than equity. So I'm explaining that I know what gearing is. Now, if the loan is granted, the gearing will increase to 55.13. Now, how I work that out, currently my debt is 200,000 plus 150, so 350 over 879. That gives you 39.82. If I add on 300,000 to that, it'll be 200 plus 300,000 is 500,000 plus another 150, so 650,000 over 879 plus 300,000, so over 1179. So don't forget to add on the 300,000 to the debentures, but also onto the capital employed. So it'll be, as I said, 650 over 1179, which is 55.13%. So we can say within that they're now going to become highly geared. If the loan is granted, it's highly geared, but it's not very highly geared. It's just over the 50%. So we can say what that means. They're more financed by debt than equity. I wouldn't get too caught up in that. It's just important to show that we know the gearing is going to change once the loan is issued. The interest cover, 8.1 times. That was our answer from first part of the question. Increase from 6 times the previous year, which is a positive trend. Again, explain what interest cover is. Number of times that interest can be paid out of profits. What does that mean? It means the company is in a strong position to pay its interest, and the added interest is not going to put them under too much pressure. So they'll be able to take on that extra bit of interest if they take the loan on board. So again, referring to what happens if they get the loan. Okay, the debentures one, you always have to talk about security and the real value of fixed assets. So if you see here, we're given intangible, tangible, and investments. So our fixed assets in total are 830, but really our tangible assets are 580. But we do have to refer to these investments as well. So we're going to get all of those in. So fixed assets are 830, and that's well in excess. I always compare the fixed assets to the debentures. So it's well in excess of the 200,000 debentures. And if the loan is offered, it's going to be above the total debt of 500,000. But from that, tangible fixed assets are 580. So if we take, always compare that to what the loan is going to be. So 580 less the debentures and the new loan. So less the 200 plus 300. So 580 minus 500,000 is 80,000. So there's tangible fixed assets of 80,000 above the loan. Now that's a really good thing. Now you always put in your line about not knowing about the fixed assets because there's no depreciation policy given in the balance sheet. You can talk about your investments. They've gone up in value. Their market value is 120. Their cost was 100. So that's good financial management. Again, I should have put that in actually. So I should have said investments have appreciated in value and put that in brackets, and then said showing good financial management on behalf of the management of the company. So we can say there's more than sufficient assets in the business to secure the new loan against. Okay, so they've plenty of assets, and that's what we really want to say. Their assets are well above their liabilities at the moment, and they will still be, their fixed assets will still be above their long-term loans if the loan takes place. Okay, then we're on to your sector. Now, sector, I wanted to stay positive on this because I'd already made my mind up that that I was given the loan. Okay, so I want to say, well, where are they? They're in the health food manufacturer. So I want to say, well, how do I come across positive as that? So short and long term, remember, and 2 positives, 1 negative is how we want to go. So short-term prospects are strong as it's a growing business with that should say growing industry with more people being more health conscious. In the long term, prospects remain strong as once people get into health food, they tend to remain with it for long periods. I just made that up. It's just something to say. I wanted to put in my negative. We should note that health foods can sometimes be fads. However, the industry should continue to grow strongly. So I was positive, negative, and then finish with a however. That'll get you the marks there. My final part then, the purpose of the loan. Now that is new. We never really have to write about the purpose of the loan in any of the other ones because most questions you don't have purpose of a loan. But we know that what they're getting the loan for, so we should write about it. And I'd say there'll be marks in the marking scheme for writing about it. So the loan is to finance the modernisation of the manufacturing plant. So I read that and I went, okay, I want to be positive about this. So I want to write down that they're upgrading a manufacturing plant. And if loans for specific purposes are favourable when granting loans. So you know exactly what they're doing. And then if you upgrade your manufacturing, it should make the plant more efficient. And if you make it more efficient, you should be able to produce more of the products in a cheaper manner. So it's a good use of a loan. Okay, and that'll get me very close to 40 out of 40, if not 40 out of 40 in that. Okay, which just leaves me with my part C. So it said employers are users of financial information. If you were an employee, explain why the financial information of the company would be of interest to you. So if I was an employee, if I was to be interested, why would I be interested? So employees are concerned about 2 things really. They're 3 things, I suppose. Their payment, their job security, and their promotional opportunities. Okay, so we can write about those. So as an employer, I'd be interested for the following reasons. I want to know how secure my job is by looking at the profitability of the firm. I want to see if so that's my security. My payment, I want to see if they can afford to give me a pay rise. And promotion, I want to see if they can expand as this might create a promotion pathway. Now, elsewhere on payment, you can also put in things on the dividends, on the pensions and stuff. So often in companies, there'll be a share purchase scheme for employees. So I might want to put in that. I want to see if dividends will be paid or to see how secure my pension scheme is. So they're my extras just to make sure in case you needed more than 3. But even if you never did accounting, you should be able to come up with those 3 things. What are employees interested in? That's what you have to think about. They're interested in how secure their jobs are, how they're going to get paid, and can they get a promotion. 2 other users of financial information. There's a whole heap of users. So competitors, creditors, debenture holders, shareholders, the revenue, so on. Think particularly about the other aspects you can be asked about. So you can be asked about to analyse the companies from a shareholder's perspective or from a debenture holder's perspective. So there's 2 straight away that you should be able to get. And you're just asked to list them. You don't have to explain them. So hopefully that's of use to you, lads. I will keep going at these over the next week or so. I'll try and get 5 or 6 done in total. We'll see you again.